Good afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young. Today is May 23rd, 2024, and today we're going to be talking about bonds break and sends everyone to cash. Today was really not about Nvidia like everybody expected it would be. After Nvidia's earnings, everybody thought all the focus would be on Nvidia, but reality is there is only a fraction of the focus on Nvidia while bonds sold off, the dollar rallied, and commodities crashed. So we're going to look into each one of those a little bit closer as we're watching this market kind of play out from its previous trends. To start with, I have the ZN up. This is the 10-year bond, and when we look at this move down, we had the breakout out of this consolidation, spiked up, we've returned to that, and this is the lowest close we've had going all the way back to May 3rd. So almost the lowest close we've had for the month. So that's breakout seems to have been a fake out. Now, when bond prices broke higher, that drove yields lower. But now that we've returned back down here and we're fighting and closing down the lowest close in 3 weeks, almost for the month, if we push any lower, we'll clear out that low and we're likely to get back into these lows over here about 107.25. Now, that move down to 107.25 should drive yields higher. So we're looking at yields. We're going to go to CGI, or better said TNX CGI, and you can see that the bond yield spiked. So the bond yield spiking created a higher borrowing cost, a higher interest rate, and that is going to put additional pressure on the market. But as we're watching bonds sell off, one of the things I like to say is equities, or better said money or investments, are like matter that's neither created nor destroyed. Now, clearly we know it's created all the time by the Federal Reserve or other central banks, but it's not destroyed. So when we see bonds selling off and yields rising, the money had to move somewhere. So if it's selling off bonds, oftentimes we'll see money run into gold or into equities. Well, we didn't see it move into equities. We saw it move away from equities, away from bonds, away from commodities, which left us with the US dollar. So the US dollar gained and gained and gained. That's an indication of a flight to safety or flight to cash. And so we can see the move today is a follow through to 6 days in a row, because this one is a slightly higher close, but 6 days in a row of higher closes from the sell-off last week. Now, that's a great recovery off of the lows. It's not super incredible because we need to get through this, but it still did break through that big single day. Now, that's a 0.78% range. That is a full 1% recovery, and a 1% recovery in the US dollar, or the US dollar climbing by 1%, should see equities as indexes drop 2.5. And we should see individual stocks drop 5% in the same time frame. So if we're looking back 5-6 days, so in essence a trading week, we should see equities selling off at about, indexes wise, about 2.5% from those highs. If we look at the individual equities, let's go through the ES, the Nasdaq, the NQ, and the Russell, the RTY, to take a look. And I'm using the June contract, which is the front month contract, just so you can see the specifics to this particular contract and the magnitude of the sell-off. Today's move, even though it's down only 0.78, tells us that we still have more room to fall. From the highest high, it tells us that we could still continue to slide. So if we take a look from the highest high as a percentage from today's high that was driven higher based off Nvidia pushing the markets higher in the overnight, we've dropped 1.81%. 2.5% would put us down here. Now, a 2.5% move would bring us down to 52.32, back into this support area, back into this area, and create that breakout through the record highs as a fake out. Take a look at the Nasdaq for the same time period. Again, this is the June contract, and today we can see that it's down at 0.5%. But from the high that the Nasdaq just got pushed or propelled by Nvidia to the low, the range itself is already 2.13%. So even though it took some time, even though the dollar was gaining, we're still seeing the dollar play out into this fake out breakout, the reversal of about 2.5% in the Nasdaq as well as in the ES. Now, the Russell is a different story because the Russell is going to be more impacted by these higher rates and not helped by Nvidia. The small cap stocks have to borrow at these higher rates. You can see the Russell futures as far as the June contract goes. We never reached a 52-week high. We rolled over ahead of time, and the last 1, 2, 3, 4, 5, 6 days, mirroring the opposite of what the dollar index was doing, we've dropped for 6 days like the dollar has gained for 6 days. And from the high to the low, the move there isn't just today's 1.85% move, but the high to the low today, we can already see that we've gone 4%. A major sell-off as far as the Russell is concerned, mirroring or reflecting the opposite of the dollar. The dollar was so strong that we reversed gold off of its record highs, or at least its annual highs, off of that 200% level, which was the year's monkey bar, broke it out, reversed it back all the way to fair price. From the high to that fair price, from the monkey bar yearly level to the fair price, gold has pulled back 5%. And so we are seeing those reciprocal behaviors in commodities and equities like we normally expect to see. So what's going to do better in this market? Because I know a lot of people don't like shorting or going bearish in the market, which now could be the time. We could have put in the top. We could have reached the pinnacle of the market and could be looking at the next major downturn, and could be facing that recession and higher interest rates impact to the markets as of today. So we will want to still be bearish, and we're going back to be bearish in housing. We're going to go back to be bearish in the Russell. We're going to go all those that are very sensitive to interest rates and go against them. But if we look at the sectors, we'll see that everything fell against the US dollar today and yesterday. And we can see sector-wise, forgetting that the Nasdaq lifted to record highs in the broad indexes, every single sector is down for the last 2 days. In fact, some are 3, some are 5, some are 6. But we've definitely been selling off. If we look at just today and the moves we've seen today in these different sectors, you can see who's performed and who's underperformed over the last trading session or the previous 2 trading sessions. And way down here at the bottom, you're going to see it's real estate. It should come as no surprise that the higher interest rates are going to hurt real estate more. Real estate's down 2.73% in the last 2 trading sessions. You look at the top performer, and it should come as no surprise it's healthcare. So even though healthcare is down 0.68%, it is more resilient. The next in line is consumer staples, but we've talked a lot about consumer staples over the last few weeks. So I wanted to kind of freshen it up and talk a little bit about going long or being bullish or selling premium against some of these health sector stocks. Maybe still looking to be bearish in the home builders or the real estate sector, but focusing on healthcare. Taking a closer look at healthcare today, you can see Eli Lilly was up positive, so we will look at Eli Lilly as an opportunity to be bullish. But we're also going to look at Bristol Myers. Now, Bristol Myers has been selling. It is way down. It's oversold. The professors talked a lot about Bristol Myers and so Bristol Myers Squibb. And so we're going to look at Bristol Myers as well as far as timing is concerned. And as we look at this, the idea behind the healthcare sector, when we go look at XLV as an ETF to include all of this, it is that during an economic slowdown, during a turn down in equities, generally speaking, we like dividends, but we also like the stocks that we have to do or buy or use every single day no matter what. That's why we focus on utilities, healthcare, and consumer staples during a difficult or troubling market. So if I can do that, if I can focus on healthcare, consumer staples, and utilities while the market's slowing down, even if it doesn't go up much, we can collect premium and collect dividends while we wait for the economy to recover. So let's go look at these individual stocks. As you can see, Eli Lilly gapped higher and closed down slightly, but still gapped higher and closed up. We've broke through a 52-week high. We actually cleared the consolidation through here a couple of days ago, but today is a follow through with a gap up. And so we had a gap up, close higher than yesterday, closed down for the open, but closed higher than yesterday, fairly resilient and a retest of the gap. And so I like Eli Lilly purely from a technical pattern because the move here, if we go down to these closes, we're about 720 up to, and I'm not going to the highest high, I'm going to the closes and looking for that area right through there from 720 to 790. I'm looking for a 70-point move, which means 850 is on my target. And so I would be looking for Eli Lilly to run to about 850. Now, the opportunity in Eli Lilly there is going to be based off of whether the options are expensive or cheap. So we scroll all the way down and look at the current IV percentile. Anything above 35, 37, you can probably get a decent premium, but 37 is still in the lower half. We're past earnings, we're past expectations that way, and so it could go either way. As you know, if I'm going to sell a put into something, especially on a breakout above the 52-week high, I want to get paid at least 2.5% if I'm going to short a put. Otherwise, I'm just going to buy the stock or buy a long call. If I go into this and add in the return on risk, and you do that over here, and just type in return, you put on return on risk, and it'll tell you as a percentage, if you get assigned 805 is 2.7% enough. It's all right. It's on the edge for what I like, but we could sell here at 805, the gap, and they're willing to give me 2.7% to just be willing to buy the gap. Buy it at a cheaper price, buy it down at 805, have it fall back 350, and we'll give you $20, $21 to do that trade. So I could get $21 on that. That does seem like a lot of risk to be set up to be buying at 805. And so if you don't want to do that, then it would lean me over to the call side to do the in-out spread type of behavior. To do that, we'll go back into the positions intrinsic, extrinsic, and we're going to go ahead and look to buy a delta near 70, and we're going to look to sell enough premium on the out of the money option or at the money option to collect all that extrinsic value. So if I'm going to buy, say, the 795, I'm paying $19.45. I could sell the 815, keeping in mind that we think it's going to go to 850, and we would collect about $3 of time decay, even though it is a long call vertical. And it would look something like this. For $10.50, we can buy a $20 position. It is half the cost, but we have a positive time decay situation. In addition to that, we are buying a delta near 70, really 62. And so as long as we stay at the money, this trade will pay us out. If it doesn't move at all, our $7.95 is going to be worth at least $13, and we're paying $10.50. So this actually works out. If it doesn't move, we're safe. If it does move, we're safe. If it moves up fast, we're safe. But we have the potential to make $20 for a $10.50 move. In fact, the break even on this is 805, roughly where we would be stepping into that trade if we got assigned. The difference is that we have a max exposure on this one versus a short put. Let's go take a look at Bristol Myers. 53% implied volatility tells us we're getting paid more than usual on the options. If we look at the charts for Bristol Myers seems to be in a free fall, down and down and down. In fact, they just took a $4.40 miss on their earnings. They took a loss, and we've continued to move lower, and it appears that we've reacted to this 440 loss and then continued that roughly the target of the price pattern. So the question is, can we catch this falling knife, or is it done falling at all? Can we avoid the risk? Can we step away from this? And what I want to do is look at it and say, can I get paid enough that I can look back historically and see any type of value here? This is a 3-year low. In fact, it is the lowest price we've been at for Bristol Myers since 2013. In addition to that, I find the fundamentals interesting that they still have, even though they're just getting destroyed, they still have cash, they still have assets that can meet their demands. They have enough cash to meet their assets without selling inventory. And so the quick ratio is above 1. The current ratio is above 1. We look up here and we see cash flow and free cash flow is positive. We see that the return on equity is positive. The return on assets is positive, even though it's sliding. So they have a number of things that are going for them. Net profit sales is positive as well. So as we're looking at this, their sales per share have been increasing. Their margin has been increasing. They have cash and the ability to meet their debt. So to me, this is a situation where this could be highly discounted and an opportunity to be selling premium into Bristol Myers until we own it. The at-the-money price of $41.54 says if we sold a put on this, they're only going to pay us 2.3%. That is lower than I expected as prices continue to sell off. So we've dropped. It only gives us about $1 cushion from $41.50 down to $40.50. And if we look at the chart again at $40.50, we're talking about a move all the way through the 2013 year. That is a major sell-off. The price of the stock just last year was at 81. It's been cut in half. Now, does that mean it's a good value? Well, the price to book ratio is about 6 times. So we're trading at 6 times if you just liquidated the assets, and we're not paying attention to the fact that their sales are rising, their cash flow is rising, their margins are rising. And so this is still something that I would consider just selling a put, but I'm going to let it bounce. So what I'm going to encourage you to do is watch this and watch for a bullish day that clears today's high. Watch for a pause tomorrow and then clearing that high. So whenever we stop falling, as soon as we clear the high of the lowest candle, that will be the signal to me to buy as close as we can to the low, or better said, sell the put as close as we can to the low as we're watching for this to go up. Now let's look at XLV as a general position in healthcare. You can see healthcare pulled back off the highs today, but it's also in this yearly oversold area. And so anything above 143, any bounce today, tomorrow, the next day, would be an opportunity to buy in here, or a close above 145.60 would be an opportunity to buy, create a cup and handle, create a monkey bar breakout, and I'm looking for moves not just back to 150 but up to 155. I want to see a pause or a retest of 144, and at 144 I'll consider buying if it doesn't close below that gap. As far as the options go, again, we want to see it stop falling. If we go over here, a short put is only going to pay us 0.99, which means we want to do an in-out type of spread. Because I'm looking for a move all the way up, $11, I don't think that's going to happen over the next couple of weeks. And so I would go into this with the idea of going out to July or September and buying options out there. And so if I can buy options out to July or September and buy a delta near 70, say the 142, if I can buy the 142, the spreads are a little too wide right now, now the market's closed, but if I can buy there and I can sell a delta near 30 in the front month, this would create a diagonal looking towards my target that would give me a 66% probability of not getting called away and an opportunity to potentially buy a 550 spread for 340. It's kind of an in-out spread situation where we're paying for the time decay, but then we have the opportunity to sell more premium against it as we roll June into July. Taking a look at the implied volatility and the extrinsic value, we're going to see a better indication right through here that we're not going to be paying $5.90. We're going to be paying closer to about $3 or $4, and the extrinsic value is 144 that we're buying out into July. We want to sell all of that, but right now we're only getting about $1.15 out of the 147s or 96 cents of the 147.50s. So we're not quite at 100% of what we would want to collect. If you wanted to go a little bit lower, you could sell the 146.50 and buy the 142. It'd create a 450 wide spread, but then you collect about $1.20 of time decay. Everything would be paid for time decay wise. You'd have the opportunity to make about a $4 move. Now that would only be $2.89 for a $4 wide spread, but our intention is not to be called away. Our intention is to have it get close to the 146 and roll June into July and hopefully collect another $1 or $2, bringing our costs down to closer to about $2, maybe in $1.50 as we approach that, and move out the short side to maybe 147, 148. That could give you an opportunity to let it run all the way up to the top area, and maybe even over time we could do the same thing and push it all the way out to get to that 155 target. And that would be a bounce here, a price pattern of 148 down to 138. $10 move would take you up to 158. I'm just talking about 155 to get up into this next distribution area, TPO or monkey bar level at about 155. Well, that's going to do it for me today. Don't forget, you can still be looking at real estate short, but don't forget to join me again next week as well, and tomorrow morning as we do our TheoTRADE live in the morning. Otherwise, I will talk to you again next week.